We've always heard people complain that the market is a little bit boring. There isn't enough high-tech growth companies that the younger investors want. They want fast growth, fast gains. So this potentially could give them what they want.
The Singapore Exchange has launched its SPAC framework, and we're seeing the first few sponsors launch their prospectuses. So, Raphael, you've been looking at this space for the past 1 year, correct?
Yes.
And after having seen so many documents, looking through all those pages,
Yes.
what are some of your initial thoughts about this?
I think it's quite exciting times for our local market actually. We are seeing 3 sponsors with quite an interesting background coming to launch SPACs on the Singapore Exchange. We have a European asset manager, TKO. We also have 2 local players, Vertex and Novatelis. Vertex is a venture capital platform. Novatelis also does some investments. It's a private equity manager, but it also has investments on the Singapore Exchange. And all these sponsors, they have gone above what some of the minimum requirements SGX has prescribed. They've gone above in terms of the amount of equity participation in the individual SPACs. They have also put more money in the escrow accounts. Some of them also have structured their promote to a staggered basis so that the benefits only come if investors already benefited. So these alignment of interest, I think, would be of interest to investors, and yeah, some might find it worthwhile considering these investments.
Okay, so all that sounds great, but honestly, as an investor who's just looking at these kind of structures for the first time, right, what kind of risks should I be aware of before I jump right in?
Right, I think it's helpful to think of SPACs in terms of 2 stages of their life cycle. The first is between IPO and business combination. The second is post-business combination once the combined entity trades. In the first stage of a SPAC's life, you are relatively protected because you have the right to redeem from the escrow account, and if the sponsor doesn't manage to find a deal, the SPAC will liquidate and all the initial IPO capital would be returned to investors. So barring any unforeseen circumstances, you are relatively protected. In the second stage of a SPAC's life, post-business combination, the track record in the US doesn't suggest that they do too well. Even Grab has not been immune from its shares going below IPO price once it started trading post-business combination. So I think 2 key reasons that people have suggested are, valuations are a reason why counters tend to decline. The second reason is also dilution. SPACs have warrants that comes during IPO. Sponsors also get promote shares which are obtained for a nominal consideration at the start. So these are dilutive elements that you should be thinking about if you want to hold through a SPAC's entire life.
Okay, I just want to go back to your first point. At the point of business combination, you mentioned that if I don't like the deal, I can just redeem my capital and then keep the warrants.
Yes.
That sounds to me like a really good deal, whether or not I like the deal, right? I mean, wouldn't potentially a lot of investors just do that?
Yeah, so you have rightly described an arbitrage opportunity in SPACs. People can actually just buy the units at IPO, sell or redeem the shares and keep the warrants essentially for free to profit. So this is quite lucrative, I think, and some people in the US have been doing it. But it doesn't mean it's the best option, not necessarily. I mean, if you believe that the eventual target company has potential, it can outperform, it can grow to a much larger size than what it currently is at, you might find it rewarding to hold a larger exposure to this target via both your shares and warrants versus selling your shares and just waiting for the warrants. So ultimately, it depends on the risk-reward trade-off that is worth it to you at the point of de-SPAC and whether you want to continue holding or minimize the risk and sell it and just say, I'll try my luck anyway.
So I have a final question for you. So the Singapore Exchange, right, they spend a great deal of time deliberating the entire structure, engaging in industry consultations, right, to come up with the framework that they want. But in the end, they came up with something that I feel is broadly similar to what we already have in the US. Do you think that's a good thing or a bad thing?
I mean, yes, there are some similarities with what the US has, but I don't think that is necessarily a bad thing because it's something that people are very familiar with, so you don't want to shock the market with something totally different that ends up with, nobody coming to use it. So I think what the SGX has said that they would focus on is alignment of interests, and this has come from the minimum equity participation they expect from sponsors. They also said they will look quite closely at the sponsor's track record and their relevant experience. So this is so important as well because you're giving sponsors essentially a blank check to find a company for you. You want someone with the relevant experience. I think in the US you had all sorts of different players coming in last year at the height of the SPAC boom. I'm sure you're familiar, right?
Celebrities, sports stars, all of them.
Yeah. You have some of these players with less obvious expertise coming in, which could be more risky for investors. So the Singapore framework focuses a little bit more towards alignment of interest to protect investors in that way. What we have seen so far, I think, is that the first few sponsors are showing that their vehicles have that structuring in place. They are going beyond the minimum requirements to invest in their respective SPACs. In a way, they're putting the money where their mouth is, which investors might find a little bit more reassuring than having the sponsors' interests totally misaligned. So but really, the proof would be when the D-SPACs come and how the SPACs perform thereafter. And I think it remains to be seen how that pans out down the road over the next 2 years.
Sounds like an exciting time, and obviously you're going to be very busy covering the market, and I'll be busy watching out for the potential tech companies that might go public through this route.
I think it'll be a busy time for everybody, but it's also an exciting time for the Singapore market, right? Because we've always heard people complain that the market is a little bit boring. There isn't enough high-tech growth companies that what the younger investors want. They don't want stable yield stocks, they want fast growth, fast gains. So this potentially could give them what they want. So would you invest?